before I get into the presentation, I want to just tell you a little story about myself. When I was going to UNLV, and I came to the point where I needed to decide what my major was, then I had the choice between a couple of things, but really the thing that made my determination was specifically I was looking for two different things, right? As one, I wanted to make sure that I could get whatever I could do so I could graduate the fastest. And two, I wanted to do something that I would never have to do any public speaking for. So I naturally gravitated towards accounting, and then I got into the accounting program, and the interesting thing was that right after I got into the accounting program, they changed the CPA requirement to require a master's degree instead of a bachelor's degree. And so, unfortunately, some of the best laid plans don't always work out. But regardless, I'm still glad to be here today talking about the new tax law. So this tax law that just got passed, and I always have to refer back to, I gotta read it because for whatever reason I can never remember the name of it, the Tax Cuts and Jobs Act, which was passed in December of 2017. The purpose of this tax law was primarily to cut taxes, but also they wanted to have a simplification of the tax code to make it so that it's less complicated. So as we go through some of these new provisions, you're going to see the level of simplification that was actually put into this. A couple of things that the tax law did, we're not really going to get into detail on in this presentation, but it did get rid of the individual mandate for Obamacare, which is a very interesting story because when the individual mandate came out, which was in 2015, you were required to have health insurance. And then in 2016, they came out and said, hey, you know what? If you didn't have health insurance, we're not going to ask you about it, so you don't have to report it on your tax return and get penalized for that. That was on the 2016 tax return. So then they passed this law for 2017 saying in 2018, you don't have to have insurance, but even though we let you get away with it in 16, you still have to have it for 17, and so we're going to penalize you. So they started it and they stopped it, and then they started it and now they're stopping it, and hopefully it'll be stopped for good.
So in other words, they're not going to have Obamacare at all?
So parts of the Obamacare are still there relating to large businesses, but for the individuals, it's totally gone starting in 2018. So you no longer have to have the health insurance. The other things that it did is it tried to do a little bit of a fix on the alternative minimum tax and the estate tax. It didn't really fix those the way that we wanted to, but at least it made it so it applied to a lot less people. So that's helpful. Then the other thing that the IRS did, or that Congress did, is in February of 2018, they decided that the tax cuts that they passed weren't quite enough. So they came out with the Bipartisan Budget Act of 2018. And I love it when Congress does this, because February, you got to realize a lot of people had already filed their tax returns, and then Congress decides that, hey, we're going to make some laws retroactive back to 17 that will change how people are filing to give them some additional breaks, right? And there's a lot of things that went into this one. The ones that mostly affect this group is that it did bring in the exclusion of income for short selling your personal resident. So that came back for 2017, but has not come back for 2018. So hopefully the short sales will be done in 2017. The other interesting thing was that they had added a deduction for the mortgage insurance premium that you pay. And that was something that the banks were then required to put onto the 1098 forms. So of course they repealed that, and so a lot of the banks issued their 1098 forms in January when they were supposed to and didn't list the mortgage insurance because it wasn't deductible when they created that form. And then of course then it became deductible, and so we had to go back to a lot of our clients and say, hey, go back and find out how much you paid in order to get that deduction. So a couple things like that. I would have much preferred that they did it timely, but that's the way that tax law works sometimes. So those are the two big changes that are affecting us for 2017 and then rolling in for 2018. Now, the idea of the tax cuts is that your taxes at this point now should be so simple that you can file on a postcard, right? So here's the postcard that they want you to file on. Now, I'm not a tax expert. Actually, I am a tax expert. When I look at this, I'm thinking this will never work, right? Because one, there's no place to put your name and social security number, and two, why would you send this in on a postcard, like with all your personal information? So right off the bat, I'm going to say that this right here is never going to happen. But ultimately, the idea is that if the taxes can be much more simple, then it benefits everybody. So before I get into some of the changes that came about, I want to talk a little bit about what stayed the same. So the interesting thing about tax codes is they'll talk about them for months and months and months before they actually get passed. And they'll say, well, this is going to change and this is going to change, and then people will call my office and say, hey, I heard about this and I heard about that, and how's this going to affect me? And most of the time we're just like, there's not even a bill signed, so I have no idea how this is going to affect you. These are some of the items, though, that they were planning on making radical changes to that ended up not having any changes at all. So capital gain rates are still the same. They were going to change the sale of the principal residence exclusion, where you had to hold it for 5 years instead of 2 years. They ended up not doing anything with that. They were going to disallow gambling losses, which would have been great for Las Vegas. Ultimately, they didn't really make a change to that. And they were going to do some things with the student loan interest, a couple of other little things like that. None of that has changed. So all of that is going to be basically the same rules that you are used to. Before I get into kind of the meat of the business part, let me tell you a little bit about the itemized deductions, because this one is going to significantly affect a lot of what I call the regular people, right? And this is just people that have, jobs with wages and W-2s, mortgage interest, and that's all that they have on their tax return. So the way that the itemized deductions work now is they're actually doubling the standard deduction, which sounds great. Doubling of the standard deduction is going to make it so that, for the most part, a lot of people are no longer even going to itemize their taxes anymore, which gets it back to that simpler form where there's very little work that's needed to do on the tax return. A little bit of a caveat, though, is that while they doubled the standard deduction, they removed the personal exemption, which was about the same as doubling the standard deduction. And so that really doesn't net out to helping anybody, other than the fact that it just prevents you from filing Schedule A. They changed the medical limitation to 7.5% again, so this is another thing that's been bouncing back and forth. It was 7.5, then it went up to 10, and then for some people it dropped to 7.5, and it kind of moved all over the place. So now it's back permanently down to 7.5%. They've added something called the SALT limitation. This doesn't really affect us as much here in Las Vegas because we don't have the state taxes that we have to pay. But the SALT limitation just says that the most you can deduct in property taxes and state income tax and sales tax is $10,000 on your tax return. They've made a big change in the mortgage interest deduction. We'll talk about that here in just a minute. The biggest thing, though, is that they changed what are called miscellaneous 2% deductions. So these are things, most commonly, these are your unreimbursed employee business expenses. This is your investment fees that you pay to your investment advisor. This is the payment that you make for your tax return. So that whole section of the Schedule A, starting in 2018, has just been completely removed. So, and that's actually kind of, to me, is a good thing because that's where most people did all their shenanigans on their tax returns anyways. And so by removing that section, it's going to remove a lot of what the IRS had been auditing on people because it'll be totally gone.
You're saying no more 2106 expenses?
No more 2106 expenses.
So you're trying to just backtrack. Doubling the standard is kind of if it was normal and then you're putting some 2106s,
You're hiding them?
hiding them here, but now it's gonna be standard. You're gonna be able to put twice as much in the standard.
Correct. So, right, so as an example, right, currently the standard deduction for a married filer is 12,000 and some change, right?
Yeah.
So starting for 2018, standard deduction is gonna be 24,000, meaning for a lot of people, and all you have to do is just look at your 2017 tax return. When you run through everything, if you don't have $24,000 of itemized deductions, none of that's gonna make any difference anyways,
Right.
right? So you'll just take the standard and you won't have to fill out any of those
Gotcha.
other forms.
So the standard, okay.
And that's how they're simplifying it. But some people are gonna come in, they may have $30,000 of deductions, but maybe that 2106 is giving them $5,000 or $6,000 of deductions. And when that part gets removed, now that drops them back into, standard deduction filing.
So come next tax bracket, there will be no standard, there will be no Schedule A.
Well, the Schedule A is still there, so if you have a lot of mortgage interest, if you have a lot of charitable contributions, a lot of medical expenses, you still could be put into that position where you'll need a Schedule A. It's just that it's going to affect a lot fewer people to do that. So, but this one specifically for you, because I know this is near and dear to your heart, this is the simplification of the mortgage interest deduction, okay? It used to be that you could deduct the interest on up to $1 million of mortgage debt, and on top of that, you could add an additional $100,000 of HELOC debt, and that became your itemized deduction. So what they've done now is they've reduced that to say that you can only now, going forward, you can only deduct the interest on $750,000 of mortgage interest, and you can no longer deduct the interest on HELOCs at all. Okay, so that's how the law is written. Now in Nevada, that doesn't necessarily affect us so much because our home prices haven't gotten totally out of control yet, but certainly in other states like California, you're going to see this kick in. Here's the part though that makes me the happiest is one of the favorite things is when a client will go somewhere and they'll get some tax documents and then the person that prepares the tax document says, I don't know how that works, just your CPA will fix that. Take care of that, right? So they're like, oh, great, so I'll just take that to Adam, he'll take care of that, everything's fine. So this simplified law right here, so what they've done is they said, look, if you had a mortgage prior to 2018, we're still gonna let you keep that $1 million limit on that mortgage, but if you get a new one, then the new one is gonna be subject to the new limitation. And then if you go back and you decide that you need to refinance the old mortgage, well, we're gonna give you the $1 million limit on the refinanced one as long as you don't take any extra cash out, because then if you do take cash out, then only the acquisition indebtedness portion, which I have no idea how you're really gonna calculate or keep track of all that. So only that part of the interest is gonna be deductible, the rest of it is not going to be deductible. So I can foresee, especially over the next couple of years, there's gonna be a lot of these schedules trying to keep track of what's deductible, what's not, and trying to figure that out. And then the other interesting thing as we dig into the actual law, not just the captions, is that even though there's a caption that says HELOC interest is absolutely not deductible anymore, if you use your HELOC to make an improvement to your home, then it is deductible. So now you got to look back and figure out, well, what did I use my HELOC on? Did I pay off debt, or did I put in a pool, or whatever? And then keep all that documentation, because the IRS is going to get a form saying this is a HELOC and it's not deductible, and then we're going to try to deduct it anyway. So I would have preferred them just to say, you know what, this is the way that the rule is going forward. They chose not to do that, so that just is more work for me on that. So just a couple of planning tips. Is one, there's something that's called deduction bunching. So if you're in the situation where you're married and you only have $23,000 of itemized deductions, so it doesn't do you any good. One of the options that you have is you can shift deductions from one year to the next. For instance, charitable contributions, maybe instead of making a bunch of charitable contributions this year, you save them all up and you make them January 1st of next year. And then what happens is that you'll have 1 year where you'll only have $20,000 of itemized deductions. So you'll take the standard, but then the next year, because you bunched everything up and put it into the next year, now you'll have 28 or 30,000, and so then you'll be able to benefit by doing that. So that's a technique that can be used. If you're a 2106 filer, where you're getting non-reimbursed employee business expenses, then you really need to talk to your employer to get those business expenses reimbursed, because the employer can take a deduction for it. Well, personally, you can't take the deduction for it. And so I can see that there's gonna be a lot of people that are gonna come in and say, hey, look, I'm making, 20 bucks an hour and I can't deduct this. Well, what if I only made 19 bucks an hour and you reimbursed me for some of this other stuff? Kind of nets out to about the same for the employer, and that's how you would actually then get that deduction. So I can see that there's going to be a lot of negotiations for that. And then the other thing is, especially if you are going to deduct your HELOC going forward, this is the time to go back and figure out like what you paid for it, and then make sure that you have those documents. Because if you get audited 3 years later, 5 years later, whatever, the farther you have to go back in order to get those, the more difficult it is. So, let's just have a quick moment of silence for the deductions that we've lost. Go Knights. Okay. So a couple that they just scratched right off the board. So the deduction for moving expenses is gone. NOL carryback, so if you have a loss in 1 year, you used to be able to carry that back for 2 years. They've now eliminated that and made it so that you can just carry that forward. There was a deduction called the domestic productions activity that applied to, that was supposed to be for manufacturing, that really applied to like everybody, it seemed like. That is gone for 2017. But the biggest one is that the deduction for entertainment is gone. So if you're going to a Knights game with a client, that ticket is no longer tax deductible in 2018. If you're going golfing with a client, no longer tax deductible.
Well, we gotta find a new hobby.
So that's going to be a huge change. And the thing about entertainment is that some of the meals that we used to have are now considered to be entertainment as well. So for instance, you have a client that comes into town and you just want to wine and dine them because they're a good client. That's an entertainment meal, which is no longer deductible. So in after the presentation, if you want, I can email you this, but I have this report that kind of gives like dozens of scenarios of what meals and entertainment are that I can email to you to show you this counts, this doesn't count, and so forth. So that's going to be a big change for how we just keep track of things going forward. So just a couple of planning tips for this. Now that the law has changed, make sure talk to your CPA about what documentation you need to keep going forward. So I'll give you an example. I had one client who, when he would send his documentation to me, he'd send 3 pages on the economic climate of Las Vegas and the home prices, and he wasn't even a realtor or anything, just a regular W-2 filer, right? So he just sent me all of this stuff, and then a couple of tax documents, right? So I go through and I take the first 10 pages of that and throw it in the trash. But for him, he's thinking he needs all that stuff in order to get his deductions. And so I would say, hey, you know what? Don't waste your time putting that together, because I'm not even going to look at any of that. So same thing that applies with you. When you're going through and you're trying to keep track of everything and you're spending a lot of your time saying, I got to find this receipt and this documentation, whatever, talk to your CPA, because you may no longer have to keep that and put that together. The other thing is that if you're using a program like QuickBooks in order to record all of your transactions, which let me just do a quick plug for QuickBooks, you really should be doing that, then you want to go through and adjust your chart of accounts to capture some of these new things. So for instance, Used to be that the standard chart of accounts just lumps meals and entertainments all into one account. So now, because of the differences, you'll need to have those separated out and then know how to code those so that you're capturing those properly. Meals are a little bit tricky because meals, there are 100% meals, and there are 50% meals, and there are 0% meals. And so you'll need to know how to document each of those different types of meals so that you can put those into your chart of accounts. Because I can guarantee you, a year later when you're doing your tax return, you're not going to remember which meal applied to which, so you're going to end up losing that deduction. So, getting into some of the kind of the good news changes from the tax law is that once again they've tinkered with depreciation to the point now where I'm almost not even sure why they do depreciation, because they've made it so you can pretty much almost write off anything now. But that's, I guess it's something easy for Congress to understand and do that. So specifically what they've done is they said section 179, you can now expense up to $1 million worth of equipment. So that certainly is good. Specifically for real estate, and this is brand new for this year, is that they've created something called qualified improvement property, which is basically interior tenant improvements. And they've done a couple things with this, is that one, a lot of times your interior tenant improvements could be on a commercial property, you're forced to depreciate over 40 years. So now what they've done is they've said, look, we're gonna let you now take this, have it be a shorter lifespan, and because it's a shorter lifespan, now all of a sudden, section 179 is eligible to take on interior improvements. And then the other thing they did is there's something called, we all know residential real property, which is where you're just renting out a home. So you used to never be able to section 179 anything off of your rental property, but now what they've said is that the shorter life items under 20-year depreciation can now be section 179, which is kind of comical to me, because 2 years ago they came out with a new law for repair and maintenance that basically said you've got to capitalize everything now on your rental properties. We're not just going to let you write off all these things that were repairs. So $10,000, $15,000, $20,000 for repairs. IRS makes you go in and capitalize them. So now we have this law that now comes in and says, well, capitalize away, because now you can just then expense it after you capitalize it. So that's kind of interesting. Bonus depreciation has been changed once again. So bonus depreciation, what the law used to say was that you could write off 50% of anything that you bought as long as it was new. What the bonus depreciation is going forward says you can now write off 100% of whatever you buy that's new, which to most people you're looking at it thinking, that looks a lot like section 179, because section 179 you can write off 100% of what you buy. The bonus depreciation doesn't have that upper limit, and the drawback was that with bonus depreciation you only had to purchase it new. If it was used, you couldn't use bonus depreciation.
Mm-hmm.
So what they did is they said, well, we're going to change it, so now bonus depreciation can be used on used equipment. So again, it's kind of like, now really what's the difference between section 179? And I love the effective date that they put on this, because it's so logical that everybody can understand this. They passed the law, it's effective for 2018, but for bonus depreciation, if you purchased it anything September 27th of 2017 or later, then you get that 100% bonus depreciation for 2017. So I'm not being cynical, but I have a feeling that somebody came in with a pocket full of cash and said, hey, you know what? We just bought something on September 27th, 2017, and we'd really love for you to push that effective date back a little bit. And lo and behold, there it is. So depreciation, again, is a big change. So if you're looking to buy something, then you're going to want to review that with your CPA just to see how those new depreciation laws are going to affect you. And the one caveat with bonus depreciation, again, we don't have to worry about it here in Nevada, is that a lot of the states don't do bonus depreciation. So California, for instance, if you try to take bonus depreciation, they make you have a whole nother depreciation schedule that calculates it differently that you have to maintain. So in California, they'll accept the Section 179, but they won't accept bonus depreciation. And there are some other states that are like that as well. So getting into the real rock star of what the tax law has delivered is this brand new deduction that's called the qualified business income deduction. And this is the deduction that applies for business owners. And what it is that if you have qualified business income, it's a 20% deduction that's just added on to your tax return that ends up benefiting you. So it's only allowed for U.S. income. So if you have a business that operates overseas or whatever, only the U.S. portion of it counts for this. It's available for all entities except for C corporations, so sole proprietors, LLCs, S corporations are fine. It does not apply though to the wages that you earn. So if you're an S corporation, you're paying yourself a salary. That salary is still under the old laws, and it doesn't give you any kind of benefit other than the fact that you're required to do it. It's only for the income that flows through. And this deduction starts for 2018 going forward. And it's fairly straightforward if you only have one business in order to figure out. But if you are somebody who has multiple lines of business, multiple companies, then the way that the deduction is calculated is that you calculate it on an individual entity by entity basis, and then it flows through on your personal return where it's all aggregated together in order to come up with what the actual deduction is. So I have again a spreadsheet that I can send to you that gives you kind of the flow of where you fall into for all these various things. The easy thing though, and I'll just break down kind of the highlights of it, is that if your income is below $157,500 for the year, or $315,000 if you're married filing jointly, basically everybody gets the QBI as long as the income qualifies, and there's no limitations, there's no fancy anything that you have to do. Once the income gets above that, then they have two different types of businesses. They have the service-based income, or service-based businesses, and non-service-based businesses. So for a service-based business, once your income gets over that limit, then that deduction starts to phase out over the next $50,000 of income until it ultimately goes away completely. If you're a non-service-based business, then instead of having the income be phased out, you're now limited by the wages that you pay or by the fixed assets that you have. So if you're in a situation where you're making more than that, then you're going to have to make sure that you're paying W-2 wages in order to continue to receive this deduction, right? And it gets a little bit even trickier when you have, like in a married situation where you're working, let's say that you make $100,000 in your non-service-based business, but your spouse is a doctor making $400,000. Well, even though you're below your threshold, the aggregate of your filing is above the threshold, and so you then may need to actually then bring in and pay wages in order to keep that deduction. So that's how all that interacts. So if you're a sole proprietor, for instance, where you've never paid wages, then you need to put yourself on payroll. And knowing how much to put yourself on payroll for to maximize that deduction takes a little bit of calculations. Now, the tricky part is what exactly is a specified service business? And this is something that's probably gonna be litigated for a good deal of time, or they've gotta come out with some regulations. So they come out to say, look, for certain industries, they've just said it, right? So doctors, lawyers, accountants, performers, we're all service-based industries, right? We didn't have the money to pay the lobbyists in order to get our name out of that, so we're stuck on that. But they bring in this other thing that says, any business where the principal asset of such trade or business is a reputation or skill of one or more of its employees. So as of right now, that doesn't apply to realtors. So the IRS doesn't really think that your business succeeds based off the reputation or skill of one or more of your employees. I don't know if that's an insult or not, but you're better off being in the non-specified service business, because then you don't really have to worry about some of those income caps on that. So when we get into this deduction, again, it's a pretty powerful deduction, and we're gonna see some examples of that here in just a second. But you've gotta make sure that you review your owner's wages and your guaranteed payments, because the IRS is gonna be looking at those to make sure that those are reasonable. For instance, if you're paying yourself $80,000 a year to run your S corporation, then all of a sudden you drop that down to 20 because you want to increase your QBI, well, the IRS is going to look at that and say, well, that's not reasonable wages, and then you're going to get yourself in trouble. But on the other hand, you don't necessarily want to pay yourself too high of wages, because that reduces the amount of income that's subject to the QBI. If you fall under one of these categories where all of a sudden now you have to have wages, then again, that's something where you need to look to see either through yourself, paying yourself as wages, or paying employees, make sure that you have the right wages in the right place in order to take advantage of that. And where possible, you may end up wanting to shift income in order to then meet this. So for instance, if you get to the end of the year and you look like you are going to exceed whatever the wage or the income limitation is for the year, and you have the ability to say, you know what, I don't want to close on this deal on December 31st, I'm going to close on it January 1st, then if you have the ability to shift income into another year, then that can help you out with this. If you are somebody who has multiple lines of business, then, and you gotta be careful with this, but you can also shift income from one of your related businesses to another related business in order to benefit from this. So for instance, I have a client who is a service business, and they are in a building that they rent from themselves, right? It's pretty standard practice. The rent that he was paying to himself was about 4 times higher than the market rate for the rent. And it was just something that he had started to rent and just had never changed it, and it really didn't make any difference to him because it all comes through onto the same line item on his tax return. So for 2018, what I did was I had him reduce the rent, because the rental income is not QBI income, so you don't get the deduction for that. So by reducing that income, we were able to put more income into the service business, which will now have more income that is subject to that 20%. So moving some of those deductions around and moving some of those payments around is something where you're going to need to know which ones qualify and which ones don't, so that you can put those in the right place. So let me give you kind of an example of what this means in real dollars, right? Because again, as you're watching the news and everybody screams, oh, I can't lose this deduction, I can't lose this deduction, and this is going to devastate me, and a lot of the states threaten lawsuits and all that. So what I did was, instead of listening to the hyperbole, I just said, hey, let's put this into my tax software, and let's just see what this actually means, right? So if you are, and I did this as a Michigan taxpayer, so that it would have the Michigan state income tax for the SALT limitation. But basically what I've done is I said, look, if you're single and you're making $75,000 a year, under the new tax law, you're going to save about $357. And as your income goes up, you can see that, you know, 150 you save a little bit more, and then it starts to go down, and then at the 450 level, it really starts to go down. So this is consistent with the tax law now. So if you're single, you've always been screwed on your taxes. So you're going to be screwed a little bit less. But that's the way that the numbers break down. And you can see that if you're a married filer, then for the married filers, as your income increases, your tax savings are substantial, right? One of the reasons for this is everybody's heard of the marriage penalty. So it says don't get married, or you don't want to get married because for tax reasons, there's the marriage penalty that kicks in. So one of the changes in the brackets that you really can't see is that it used to be that the marriage penalty kicked in right about here under the old tax law, and now the marriage penalty kicks in right about here, and so they've made it so that more of your income is on par, and that's why the married individuals get such a bump. If you have a dependent, then the dependent actually benefits you because of the credit that you get for your dependent. And as your income goes up, you can see that credit for that dependent also goes up. Used to be under the old law that once your income hit around 150, then you lost the child tax credit altogether. And now you can make up to 450 before you lose those child tax credits. So that actually benefits you. And then my last column here is for married, where half of your income is QBI income. And you can see that under the QBI, especially at the higher wage limits or the higher income limits, if you were able to save $36,000 on your taxes just by doing nothing different than what you're currently doing, I think that would make a big difference in your life. And the cool thing with our software is that every time that we do a tax return, we're able to go in to say, if the laws of 2018 apply to 2017, this is what your tax savings will be. The highest one that I've gotten so far is I had one guy that owned a bunch of restaurants, and his tax savings doing nothing is going to be like $85,000 for the year. So now obviously he pays a lot of taxes in order to save $85,000. But this particular tax law change is a home run for that guy on that. So it remains kind of to be seen of how this is going to affect us. There's a lot of people that are writing stories about, is this creating jobs? Is this helping the economy? Is this doing whatever? The law's only been in place for a couple of months, so really we don't know. But as far as what I can see from my clients, they've all been fairly happy with what they're proposed to give. We'll just have to see if we can deliver on that on next year's tax returns. So,
Sponsored by Mortgage by Design, located at 5598 South Fort Apache Road.